Curtis Lowe, a partner in DLA Piper. I spent about half my time here, but I'm based in Palo Alto. And I've worked with well over 1,000 companies. I form these startups every week, and I don't even know how many M&A deals I've worked on, but quite a few.
I know how many M&A deals I've worked on because I get paid on this subject. So I'm Gene Ramirez. I run the tech group at BTIG. We're a growth focused investment bank. And what I thought we'd do is keep it collaborative, obviously. But I wouldn't be a banker if I didn't have slides. So we'll sort of walk through just a few, not to bore you, but please, if you have any questions, please ask. So I know this is more M&A centric, but what I thought we'd do is just sort of lay out some of the things that are happening from a marketplace perspective, just from here in the U.S. as well as some interesting verticals. One of which you can kind of look at some of the metrics in the fourth quarter. It's the strongest growth in 5-6 years. There's been a lot of activity, especially as of late, in ride sharing. Believe it or not, and I'll walk through some of those. There's been a lot of capital, like Linebike, OFO, etc. So it's very interesting from that perspective. What we're also seeing is, you've had this phenomenon over the last few years where companies that have been, pure online marketplace type companies get into the physical world, which is sort of counterintuitive. So they're creating these hybrid models. And you see that with a number of companies, either in pop-up stores or you see that with Apple, obviously opening Apple stores and yada, yada, yada. So that's sort of interesting in terms of what we see. Clearly the Amazon effect, if you listen to sort of a talk earlier with IVP and NEA and myself, we sort of discussed what's going on from an Amazon and, from a late stage perspective, or even early stage. One of the main things is what is Amazon doing, or if you're in Asia, what is Alibaba doing, and so forth. So, it's been exciting times for these companies. And then in terms of marketplaces that we've been looking at, either from a public offering perspective or late stage perspective, you have a lot of activity in the used car marketplace. With Carvana that just went public last year, and Room, which is a company out of New York, and Shift. Also in the real estate marketplace sector, you've been seeing a lot of activity there. Basically trying to disrupt or the intermediary. So companies such as Redfin, Open Door, and Compass that just raised capital recently from SoftBank. And then, online mattress type companies. I'm sure you've probably been to a Casper store or seen the commercials, Purple, Lisa, and others that are very active in the space. And then some fun facts, if you look at sort of from a GMV perspective, actually 3 of the 5 largest e-commerce companies, again from a GMV perspective, are from China. Taobao, Tmall, and JD.com. And the other 2 are obviously from the US, eBay, and Amazon. So there's been a shift that's occurred, as of late. But top 75 marketplaces basically control more than 90% of the global marketplace sales. And if you looked at the top 75 online marketplaces, half of those were founded in the last 7 years. So it's a lot of capital is going on, into the space. We'll kind of walk through some things that we've seen from M&A perspective, but we think consolidation will obviously continue. You saw that with PetSmart last year buying Chewy for around it was about $3.4 billion. It was around a little over 3 times revenue. And why did that occur? Well, PetSmart is a physical sort of retailer. They needed an e-commerce strategy, very similar to Walmart buying Jet.com for $3.3 billion. It was best to compete with Amazon. They also acquired a known team, and you'll continue to see that from a M&A perspective. And then the SoftBank effect. This has replaced the IPO for a number of companies. They've been very active. Matter of fact, they've deployed about 40% of their $93 million fund in over 20 companies. So they've been, like I mentioned here, they've become like an ATM for Silicon Valley. And so for some companies, this is their M&A or this is their IPO, depending on how you look at it. From an M&A checklist, and Curtis, you chime in here, but some of the things that we look at is the take rate. What's an optimal take rate? And some of the guest speakers here discuss various sort of online marketplace models, some that are managed service, or manage or light or what have you. But the real, depending on what quarter you look at, it's anywhere between 30 to 40% take rate versus eBay, which has been around 10% over the years. What's the margin profile? How do those operational efficiencies really drive long-term sort of margin improvement? That's what we look at when we're evaluating companies on the sales side. Clearly, I mean, this is sort of logical. Exceptional customer service that drives retention rate, and that drives a higher take rate. So clearly very important. Zappos and others, you can sort of apply that methodology. I think where a lot of companies get confused is GMV. That was sort of a key metric for earlier stage online marketplace companies. Usually the valuations for these companies are anywhere between 10 and 20 times GMV. And then as these companies scale and get larger and more mature, that can come down to anywhere between 1 to 3 or 4 times GMV. But as GMV, this is the big debate, should that be the right way of sort of gauging the performance of the marketplace? I know Alibaba has stated they're going to stop doing it. And so it's interesting. We kind of look more at net revenue, which is the actual revenue that accrues in a marketplace. That's probably logically a better metric. And that's driven obviously by the take rate. So very important. The network effects, I think some of the other guest speakers discussed that also earlier today. What does that mean? How does that drive the marketplace and so forth? Critical mass is critical in reducing that friction. And then global reach, and then I can't see the bottom of it. I don't know how does it move up a little bit. Full screen. Yeah, and then the last piece, and we could talk about it from a legal perspective, how you, the customer lifetime value, as I'm sure you've heard quite a bit in the CAC, what is that ratio? We've seen greater than 2 or 3, even 4 times. The higher the number, the better, logically. So it's a very important sort of ratio to take a look at.
Yeah. So so first of all, am I right in assuming everybody here is an entrepreneur, other than you?
He was an entrepreneur.
Yeah. But are you guys all company people? Okay. So you're interested in from it down the road as from an exit standpoint. So I thought I'd talk about a couple of topics that come up the most. Clients and people always ask us about. And then a couple things that everybody should be aware of that's happening right now in the marketplace. So first thing is people are always asking us, when should I sell? How do I go about selling? There's no real answer to that. But I would tell you that if your business isn't really taking off, then sooner than later is always the right answer. But if you can be patient because you have good backing and you can turn the corner and ramp up, in my experience, you're almost always better off ramping up and pulling off for the time being. And that's especially true in marketplace deals. Because usually you have all sorts of synergies and you can play off several, Google and Amazon and Alibaba and something in Europe. There's usually all sorts of partnering arrangements and strategic fits. And eventually you went up in these, because I go to these board meetings for companies every week, you went up in these interesting discussions about aligning with one or the other, and you're basically playing multiple sides of the street and playing them off each other. But once you build up that kind of demand, that you are in demand, like Zappos was, then you can kind of hire a banker, start those discussions, and the playing hard to get is a very important part of that puzzle. The moment they think that you're out of money and business is going south, that's when they start thinking, well, what parts can we salvage? What can we kind of use at this point? Whether there's a team. Acqui-hires are the worst thing in the world that you could possibly go through. If you do wind up in the acqui-hire situation, I would tell you that it's the typical large buyer is going to get all the tax benefits and stick you with all the burdens. So they're going to have a pot of money, right? Because money is cheap. And I'm going to come back to that with the interest rates and everything. And they're going to peel off a little bit for the company, just a tiny bit. And they're going to do it as an asset purchase. They don't want your corporate history or to do due diligence. And they'll typically say, well, our in-house legal team won't let us, do a stock deal. So then, you're going to pay gain on tax, and then whatever is left over after that, that gets distributed to you as the founder owner, you're going to get taxed on that the second time. And they get a deduction for having a step up in the basis of those assets. It's a great deal for them. Then they're going to take a piece and make it a retention bonus piece. Now, instead of getting capital gains treatment on all this, that's ordinary income to you for that retention bonus. And you it's hostage money. You got to sit around and wait for it, right? You got to work for it. And then they're going to have a sign-on bonus. Again, ordinary income to you, deduction to them. So I would tell you that the most important thing in structuring those deals is to try to unload the stock and try to not get hit with all the ordinary income tax. And you'll wind up with AMT typically. But if you actually have a positive deal, a good deal, these deals are almost all cash now, because at one point there were negative interest rates. Like I remember in Tokyo, you couldn't give away the money. It would cost you to give away. And now, Gene, I'm curious with, I mean, almost all the deals have been cash deals. If you went back 2 decades, they were all stock deals. Cisco and Broadcom, and the old Broadcom, and Google, all these companies were built through tons of deals where they just absorbed the company, figured out an amount of stock that they would give to the sellers, and nobody was the wiser because the stock price kept zooming up and the revenues grew. But now, interest rates are, money's free, and so people have only been doing cash deals. But with interest rates rising, and I think the Fed just increased the Fed funds rate 25 basis points. They ticked from 1.5 to 1.75, and they want to go up another quarter.
Hopefully not too quickly.
Right, but they're saying over the next year and a half, they want to go up a quarter, like 4 or 5 more times.
Could be 3 or 4,
right.
increases.
So do you think that people start going back and?
I think it has. I think it has an impact. Absolutely. I think so. It's an interesting dynamic, especially what's happening right now, where, with the exception of today, the market was down significantly of these concerns around the Chinese tariffs. And also you have Dropbox that's just priced at $21, so we'll see how tomorrow goes. But, you've had a very robust stock market, which, it drives sort of M&A activity. You've had a very active private equity marketplace, from Total Bravo, Vista Equities, Silver Lake, Clear Capital, DLA. Everyone's been buying a lot of it, and they've been paying strategic multiples. So when we look at, when we're evaluating opportunities or options for our clients, we're looking at a dual track process. If it's obviously, if we had an inbound, then we'll focus on the sell side, meaning we'll explore other options, fairly quickly. But usually, dual track process is what a lot of companies are doing now from a mid to late stage perspective. And what that means is they'll go down this path of, raising money, and then they'll also go down a path of evaluating, potential buyers. And that's really, from my perspective, it can be done in a very discreet manner, and it gives the board optionality, so they can evaluate what's in the best interest of the company. And, did Instagram sell too early? I mean, I don't know. We can debate that all day long. You can look at what the valuation could be today. Obviously, if they've been on the Facebook platform. Did WhatsApp sell too early? Did MuleSoft?
No, I don't think WhatsApp sold too early.
Instagram, yes. WhatsApp, not so much.
Yeah, 16.
But I mean,
it was good.
We do know, like MuleSoft, which we think is a phenomenal transaction for MuleSoft, which is Salesforce is paying more than 20 times revenue for that business. And when they went public, it was about $1.75 billion, and now it's $6.5 billion. And it's a phenomenal trade. So it's a very vibrant. We think it could be getting stronger, quite frankly. So we're very optimistic from an M&A perspective. Although days like today, when you've got a lot of volatility, it makes my life harder from a public markets perspective. But anyway, that's another story.
And then the buyer class, it's funny because it reminds me of my son's college admission. It used to be that you competed against a bunch of American people, and that was it. And now you have all the foreign students, you got all the the professional support, and it's a whole new ballgame. But that's what M&A auctioning is like. You hire a banker, and it used to be that you just had strategic buyers. The private equity sponsors, the leveraged buyout firms, didn't want to come near these deals because if figured the assets could walk out the door every day like a jewelry store. It's all in the head, it's intellectual property. What am I going to do if I ever foreclose? It's kind of like seed convertible notes. You can call it a debt, but good luck trying to foreclose on whatever assets that the borrower is. So what happens is nowadays it's flip-flopped. If it's a truly strategic, industry-changing deal, like Broadcom, Qualcomm, you have to set that aside because that's about consolidating market share. But if it's just about adding a business line, which is very common in the marketplace economy, then the strategic bidders aren't ponying up. But interestingly, the private equity sponsors are all over this. And I blame it on Vista Equity. And I say that nicely. Because Vista Equity...
Not getting filmed.
Yeah, exactly. They're a fantastic PE firm, has set the industry on fire. Literally, they've kind of perfected a nice model where they headhunt and get all sorts of great developer talent, and they fit them into the portfolio companies, and then take advantage of the cash flow, so you don't have to worry about the asset-based lending, the traditional model of a PE firm. You get a KKR back in 1970. So, and they've extracted enormous returns. And it's almost like a formula. Now everybody's imitating them. All these other buyout firms, brand name firms, new emerging managers are all kind of getting in on the action. So if you do these auctions, like say $100 million, $200 million deal, it's very typical that you wind up through a process with 6 or 7 PE bids. They're all like 10 to 20% higher than the strategic bids. And then you'll throw those out, and then you wind up with these PE bids. And when you get into the PE market, which leads me into my next subject, they have found interesting ways to sweeten their bids to make them more attractive, move quicker, get done quicker. The biggest tool, which has really changed the whole M&A landscape, is M&A rep and warranty insurance. If you ever done a deal, you'll have 60 pages or 50 pages of reps and warranties, and the junior lawyer will sit with you and read through it all, and you'll feel like, geez, I don't have to do this with my tax returns. I don't have to sit there with my accountant and go through line by line, but why am I doing this? And I can understand for the layperson how much torture that involves. But you really have to disclose the kitchen sink so that buyer is confirmatory, basically confirms their due diligence and has no claim on you for misrepresentation or basically forgetting to tell them about something. So you have these long disclosure schedules, and it's where a good quarter of the cost of an M&A deal from legal fees and a good quarter of the time involved, that's where it is. And so some insurers, starting with AIG, got together and said, you know what, there are very few of these that result in claims, and we can price this using the London reinsurance market. And so what we're going to do is make a product that is so compelling, everybody's got to buy it, and then let the beauty of insurance take its effect of spreading risk and spreading costs. So how it works is that typically it used to be that the bidder would split the cost with the company. Now they don't even bother. In fact, they don't even tell you. They don't. If you pick up these documents, you often don't even see the rep and warranty insurance even mentioned. All of the indemnification and all that stuff lawyers used to fight over is gone. It's just missing. It looks like a public company merger or something. And the sellers, lawyers, just roll over within reason. They'll say, okay, yeah, whatever, that looks fine. There's none of that, haggling over every little, I want a material here, I want a dollar threshold there, I want a knowledge qualifier here. It's the insurance problem. There's typically a 1% retention, which they used to split. You get half and I get half. Now the bidders, the buyers, they don't even bother. They just say, I'll take the whole retention, I won't allocate half to you. In fact, some insurers now, you can price it by paying just a little bit more. We'll get rid of the retention. You just say, we'll just insure $1 up, which seems insane to me because you'll always find something without some deductible, right? And the cost is, you won't do, like for $100 million, you normally have a $10, $20 million holdback or escrow. They'll insure like 25 million and charge a fraction, a tiny fraction. So it could cost $400,000 for that coverage. Totally worth it. And for the sellers, for you guys, the beauty is you get your money at closing. They're not going to say, oh, we need to hold back 10, 20% and put it in an escrow account at Comerica, JP Morgan, and then you'll get that 12 months. Nah, just 24 months. How about 18 months? You don't have that whole dynamic anymore. And so you should look for that in every one of your deals. It's amazing to me that everybody doesn't do it. Half of the market will go through and they just, I don't know if the lawyers don't know it, or I don't know if nobody tells them, but they don't bother, right? And if you don't say something and you don't seem really sophisticated, your bankers don't seem like they're focused on that, then the PE people say, we'll just buy it for ourselves and we'll still get the same terms from these sellers, right? Because they don't have to tell you they buy it. Insure or insure.
Just some quick metrics, and then I think we can go
Yeah.
to Q&A. You can kind of look at the multiples out there. I don't know if they hand out this presentation, but there's always a correlation between revenue growth and the multiple. And then here are some recent M&A transactions, and you probably recognize some of the names. And then some recent placements that I saw. It's not really M&A centric, but to kind of give you an idea of how active the marketplace sector is right now, especially in bike sharing, ride sharing. There's been a slew of deals here in the last 3 months. Any questions?
Yeah, what do you guys want to talk about?
Are you planning to post those slides anywhere, or people email you or anything?
Yeah, they email you. We can send it to them.
How do we know where to buy it?
Well, there's so many answers to that question, right? So Cisco took out Cerent once upon a time for $689 billion just before their IPO because they thought they'd be paying twice as much a couple of years later. Some companies like to get them early so they get the team and they can influence the product. You saw a lot of that in the internet. In between, I don't know, it's, you know, facts and circumstances, unfortunately. Anything else?
I think we're done.
Oh.
What about companies that have no earnings or losses?
Well, that's a little more talent evaluation, team, and market potential, right?
Technology,
Right.
potential, all that.
Right. And that happens. That happens. I know that Apple does that all the time. They've taken on.
Well, what's the metrics?
They look
Could be revenue per by engineer.
If I'm Apple and I'm going to do a radio or jukebox on iTunes, or if I'm going to build Apple Home, and this piece fits with that, and NPR type stuff, material fits, they'll take these companies out before they get too far along. They don't want to take Audible and plug it in like Amazon does. They want to brand it as their own. Right? You don't have all these funny little sub-services at Apple. It's very clean.
Thank you.
All right.